From our world headquarters on Bloomberg Radio and Bloomberg Television Surveillance, this hour we're brought to you by Kundert Volvo. Futures negative 21, lows out, and it is a miss. Looks like about 7% negative off of earnings. They missed by 3 cents, 54 the street, 51 cents is where they came in. Just looking at some of the great headlines here from our headline team and led by Kevin Reynolds. Lowe's no longer pursuing some projects. Lowe's sees third quarter sales down 2 to 5%. Again, this revenue miss. With us from MKM Partners, Michael Darda. Michael, we've been seeing this. Will we see this in the next quarter, indeed to the year end, where we see okay earnings but a decided revenue miss?
Well, I mean, that's really been the theme, and we've had massive cost cutting in the corporate sector. So the vast majority of companies are beating expectations. So that should be placed into context. But, you know, that's how a recovery process in corporate profits usually works. You have a lot of cost cutting, and then, you know, revenues or top line growth starts to improve afterward, and you get a big ramp in operating leverage, and then hiring and hours worked comes back with a lag, and that generates income growth and a sustainable recovery.
Let's go back to your University of Wisconsin days. How do you pull nominal GDP up? What is the self-sustaining way that you get it up? Is it an inventory wish? Is it a hope and a prayer? Is it stimulus? Is it the Red Sox doing better? I mean, how do you do that?
Well, I guess it depends on, you know, whether you're working within a Keynesian or monetarist framework. You can pull
It's August. We don't talk that fancy stuff, but go ahead. Go ahead. Well, it's Darda, so we'll do it.
From a more classical framework, you can, you know, central banks can impact nominal GDP with very aggressive liquidity policies. Certainly that you can accuse the Fed of many things, but lack of aggressiveness is not one of them. From a Keynesian perspective, you've got a ton of fiscal stimulus out there. That will be temporary, but the spend out, you know, really we're only about 10% into the total spend out that'll occur over the next 6 to 8 quarters or so. So it'll start with inventories, I think, in terms of what's visible in terms of the GDP statistics. But you got to keep your eyes on forward-looking indicators in the credit markets. They are sending an unambiguous recovery signal coming off a very deep trough in the economy.
Ken, I just got to drop this in. This headline is stunning. Lowe's second quarter same-store sales down 9.5%.
This is Lowe's, the home improvement retailer, not Lowe's, the New York.
Isn't that a big figure? I mean, that's stunning. I mean, you look at nominal GDP, what, negative 3-4%? That's amazing.
It is. Well, you know, we haven't seen data like this, you know, really in the post-World War II environment, going into a negative nominal GDP environment until recently. The collapse in corporate earnings was larger than anything we'd ever seen. So at least it's giving us a very low base to recover from, which will be an important consideration when we discuss and debate how strong the recovery is likely to be.
Well, they're going to blame housing. You know, the housing slump, Michael. When's the soonest you can see housing start to recover?
Well, I think if we look at very sensitive indicators for what's taking place in the housing market, we do see a trend now where both new and existing home sales are up. We're seeing a better tone out of, you know, weekly mortgage purchase applications. We've seen a big compression in mortgage spreads. I believe this week the Federal Reserve will have data out on lending standards, so we'll look closely at what's going on, you know, with those commercial real estate lending standards. So, you know, I think the writing's on the wall here to start to see a recovery process take shape, and we can see it in, you know, really housing and autos, those two very weak areas that sort of led us into recession, are starting to show some better trends. So, you know, this data, you know, looks horrible, but I believe if we have some patience, we'll see things turn up with a lag.
We'll get deeper into interest rates a little later on, but since we're talking about housing here, are we going to see sub 5% mortgage money ever again?
Oh, we may not, but we may not need to. You know, there's been such an enormous fall in home prices relative to incomes, and mortgage rates are very low, close to historical, you know, lows, that affordability has rebounded, you know, quite significantly. So that may be enough along with this improvement in the credit markets. That's the key. So we had low mortgage rates and an improvement in affordability, but very frozen credit markets. That's starting to change now. And I think, you know, we can see that in this recent trend that's emerged in new and existing home sales.
Well, we have seen Case-Shiller for the latest month, which was May. I think in, 14 out of 20 metro areas, prices actually turned up, even though they might have gone up only 0.1% or something. Is that the beginning?
I believe so. I mean, that's critical. And you guys had Bob Schiller in here. I don't know if he was on TV or radio, but I remember him saying, look, this is a really big deal. If this trend continues, then the bank stress test may have actually been too stringent. And I agree wholeheartedly with that.
Where are you, Michael, on this debate over spreads have come in? I mean, you've made a big deal about BAA 10-year spread coming in. How much of the moving in, the narrowing of spreads is due to government efforts, and how much is trust returning to the system?
Well, I think it's a combination of both. I mean, the spark here was obviously the Federal Reserve doubling the monetary base, last fall after Lehman collapsed. And the Fed is aimed at narrowing these credit market spreads. But we're actually seeing this has moved, well beyond LIBOR, which the Fed was targeting directly, and well beyond the mortgage rates and spreads that they were targeting directly. The Fed can't buy and isn't buying BAA corporate bonds. The Fed can't buy and isn't buying high-yield bonds, and those yields and spreads are collapsing. The Fed can't buy jumbo mortgages, and those rates are coming down.
Is it critical, though, Michael, to get BAA to 10-year, folks? This is the difference between the BAA industrial and the 10-year full faith and credit. We're at 3.08%, 308 basis points. Do we need to get that back to where we were pre-August of 2 years ago?
Not necessarily. It's really the rate of change and where we're coming from. So we saw those spreads at over 600 basis points, late last year. That was the widest level really since the 1933, since the Depression. So the economy, the coincident data has already reflected that implosion in the credit markets, and you're getting a very significant turn here. That's the key.
Now, stay with us, Michael. Darda, Mark Chandler coming up in our next half hour, as well as Abby Joseph Cohen. I want to do a data check. We look at equities, bonds, currencies, and commodities. Let's start with the currency markets right now. DXY dashing to 80, 79.44 on DXY, up a full 0.7% for that blended dollar index. Dollar yen 94.60, euro dollar $1.4065. Wow, has that come in a full percent this morning? Euro yen 133.05, and cable Ken $1.63, and on to oil where you see that dollar correlation $65.83. Michael Darda saying oil's going to $2 a barrel.
That's down from 71 just, what, a couple trading days ago.
I'm kidding about Mike saying going to $2 a barrel. We wish it was going to $2 a barrel.
We did have a forecast of 10 or even 4.
Where is oil going to, quickly?
Well, in the context of a broader global economic recovery, which is what I think we'll see as we move into 2010, I think oil's going higher at some point.
Going the other way.
Yeah, absolutely.
See, that's what we love here at Surveillance. We got, Phil Verliger saying $20. Ken, it's good to see a difference of opinion here between Dr. Verliger and Mr. Darda.
Let's take a look at some of the news you need from around the world this morning. Tropical storm Claudette made landfall on the Florida Panhandle this morning. Hurricane Bill has become the first official hurricane of the 2009 Atlantic season. Bloomberg's John Bascom will have more coming up in just a few minutes. In sports, Y.E. Yang upset Tiger Woods to win the PGA Championship. Tiger led on Saturday. That usually means a win on Sunday, but not this time. Yankees lose and the Mets win. Jerry Azar will have those stories and more sports coming up.
Jim emails in. Thanks, Jim, for emailing in from San Diego, noticing that M2 has been declining or level. We'll talk to Michael Darda about that when we come back. Much to talk about really all through the week here. Thrilled to be with you on both Bloomberg Radio and Bloomberg Television. Good morning, everyone. Worldwide on BTV. I want to talk to you, Michael, when we come back, this idea of the money supply. Do we need it to still expand? We'll have much more. The future's negative 22. It's Bloomberg Surveillance.
Bloomberg World Headquarters in New York. I'm Vonnie Quinn with this Bloomberg Radio Business Flash. Futures are at the lows of the morning as equities sell off globally. S&P futures down almost 25 points now. Dow futures down 202 points. The 10-year Treasury up 23 seconds with the yield at 3.48% and the 2-year yield at 1.01%. NYMEX crude oil futures down 2.6% at 65.77 a barrel. Home improvement retailer Lowe's is down 7.6% in early trading at 21.10. That's That's after reporting second quarter earnings per share of 51 cents, missing Wall Street estimates by 3 cents. It said same-store sales were down 9.5% in the quarter, with customers taking on fewer remodeling projects. Lowe's also gave a full-year forecast that fell short of estimates. And that's a Bloomberg Business Flash. Tom?
Bloomberg Surveillance, folks. We welcome all of you worldwide on Bloomberg Radio and television. This hour of Bloomberg Surveillance, we're brought to you by Town Motors, Porsche. With us, Michael Darda, MKM Partners. Michael, you made a mention earlier of a Fed that, to be kind, eased, was accommodative, to be polite, and part of that was a money supply expansion of M2 and the monetary base. Recently, it's gone flat. Is that a big deal?
Well, it's important to watch. The 13-week growth rate of M2 is basically flattened out to zero. Ditto for MZM. M1 is still growing pretty quickly. The Fed's balance sheet has actually been trending sideways as some of these emergency liquidity facilities roll off. But the Fed's not done with quantitative easing. If you take a look at the cumulative purchases that they've committed to versus what they've accomplished, I think the balance sheet still is headed, $700 billion plus higher. You've got
We're going to $2.7 billion on the Fed's balance sheet?
I think around 2.5, 2.6. And that's basically what William Dudley, New York Federal Reserve, also forecasted. And if you just add the commitments for long-term purchases to what the balance sheet was before the September spike, you get about $2.5 trillion. So with short rates essentially anchored at zero and massive deficits as far as the eye can see, I have a little bit of trouble believing that money growth is going to be sustainably weak here.
Does Chairman Bernanke have a political backstop if he takes us out to $2.5 trillion? On that balance sheet?
A political backstop in terms of
just Washington, just the angst out there.
Does anyone?
They have to get elected, Michael. I don't.
If anyone in Congress actually knows what the Fed's balance sheet is, I'd be surprised.
Well, but they'll use it as a talking point.
Well, sure. Bernanke's going to have more difficulty wrestling Congress over tightening monetary policy before we're back to full employment, and he will have to do that at some point. There'll be a lot of resistance to that. But in terms of the balance sheet, I mean, aside from maybe one or two senators who actually know what the high-powered money supply is, I doubt you're going to see much resistance.
Well, Michael, and by the way, thank you for wearing the University of North Carolina tie today. We appreciate it.
Absolutely.
What's the earliest you can see the Fed actually tightening up? And is the Fed going to be the first central bank to do it?
Great question. I think the earliest is probably sometime early in the second half of 2010. If we take a look back at these interest rate cycles, on the median lag between, let's say, the peak in the unemployment rate, which the Fed focuses on a lot, whether you like that model or don't like that model, that's the reality of what we're dealing with. The median lag between a peak in the unemployment rate and the first or the initiation of a rate hiking episode is about a year. So assuming that we're getting close to a peak now, we're really looking at at least a year, in my view. Coming out of the 90-91 recession, which had some similar characteristics, it took the Fed 20 months to start lifting short rates. So
I just want to squeeze this in because of time. Where are we going to go in equity markets? You do blend economics into equity markets. Are you optimistic on equities now?
I am. In fact, we became more constructive on equities in late February, so I don't want to appear to be a cheerleader after the market surged here. We could be on the precipice of a correction, at least a pullback. That's part of a normal market advance. So, yeah, I think we're higher 6 to 12 months from now, but, this is a potential correction notwithstanding.
Well, Michael Darda, thanks for coming in.